Welcome to the Dividend Talk podcast, episode number 40. Should dividend investors be worried about rising interest rates? Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you are new to the channel, please hit the like button and subscribe to us, and check out our previous episodes on YouTube and Spotify. See you on the inside. Welcome back to another show, European DJI. How's your week been?
Really good, because we're at episode number 40. So that's a nice round number, and I've been looking really forward to our podcast because it became a habit for me, and I'm so tired of being locked down and locked up in my house that it's just. I'm always looking forward for the weekend now because I get to do my podcast, and on Sunday, 5 Bullet Sunday. So how are you doing?
Well, we've had this rare thing here in Ireland called sunshine at the beginning of the week. Actually, it's the first year that I can remember that we've had no parade on St. Patrick's Day, and every goddamn year it rains on St. Patrick's Day, or it's freezing cold, and you're standing out watching parades, and it's so annoying. This year there was no parade, and it was sunny, warm. Everybody's out in t-shirt and shorts. It was incredible. So I think they should just get rid of this parade for every year and just bring on the sunshine.
Well, but what was the happy time St. Patrick's Day?
It was different. It was certainly different. Most of the time, you'd have people going to the pub, or do you mean a lot of people come together? Obviously, with social distancing rules and to keep your distance, we had a barbecue with some of our family, close family, which was fine. But it was nice and relaxed. The only thing I was chatting to Phil about IBM actually the other night on that night, and my car broke down in the middle of the motorway, and I had to wait about 2 hours. So it was a straight. Usually I'm in a pub falling around singing songs, but this time I was standing on the side of a road, so it was different. But it was nice and relaxed for the change. Look, to be honest with you, once we have sunshine, I'm happy.
Yeah, it's funny that you say that because you can have so many dividend stocks in your account pushing out a lot of I said dividend income, but it doesn't fix your car. You still need to wait 2 hours.
You still have to wait 2 hours. Yeah, maybe I should invest in some, I don't know, car repair company. Have them come and fix my car. But speaking of drinking and Guinness and what usually goes on in Ireland on St. Patrick's Day, there was some news about Diageo recently. I don't know if you've read about it. They are expanding their ready-to-drink beverage production in the US. I think they're investing like 80 million in it, which is quite good. I don't know if you have these brands, the Smirnoff seltzers, they're called, like in a can, and the flavors. My wife and her friends have gone absolutely crazy on these lately. I mean, everybody seems to love them. I believe it was the strongest growing category for Diageo in North America last year, in the second half of 2020. So that was quite an interesting one. I thought I'd share because we did cover Diageo, and they are starting to look a little bit more appealing to me the more and more I look at them.
Yeah, because when we were talking about this company, we were not too happy. I remember about it because the figures didn't look too good at the time. That's what I remember.
Yeah, we weren't too happy, but I mean they're doing some cool things, and their brand power is really strong. And I mean, after that, we both said it. I think after lockdowns, we do expect to see some sort of spike. The only problem is, when are these lockdowns going to stop? Ireland has like, we're still extended until May at least. Just had enough. I just want to go to the pub.
Yeah. I also expect to still work from home for the full year, so I don't expect a lot in this regards. Okay. Well, there's so much news today, so let's also go to the next topic. And I just wanted to bring up the recurring topic, and that's Danone, because the CEO thought that he could stay in as a chairman, but last Sunday night they had a board meeting and they kicked him out effectively. So he was CEO since 2014, working with the company since 1997, and the poor lad didn't even get the time anymore to stay. And I think it's a wise decision. I mean, come on, such a person will be totally biased. What would such a person think also about the new incoming CEO? Imagine yourself if you would be trying to find someone for your old job. Yeah, there are so many biases, so many emotions in play. So I think they did it well. The new chairman will be Gilles Schnepp, who has also a few other seats in other boards. And I think one of those was one of those electrical companies in France. I forgot the name. And I believe two of their current CEOs of North America and the other one, Veronique, they will now be co-CEO while they are trying to find a new CEO. So I think it's a good choice to kick him totally out. Of course, I also have feelings, so sometimes I do feel a little bit pity for the guy. But like I said before, he deserves it to be totally out, and I think this is the best for the company. And I hope now that we get some peace again in this boardroom, and that they get a bit of a CEO that brings a little bit of new flair into the company. That's what I'm really hoping for.
I saw his parting note. It was quite classy, actually. Did you post it on Twitter, maybe? And he had a picture of his first badge. He left a really nice message. So it was a nice way for him to leave the company.
Yeah.
So I was looking at Roblox. I think we spoke about this before. The Roblox IPO, I was looking forward to this the most. It happened last week. I was aware of it, and I planned on buying some shares for my son. I was hoping that they'd be in around $50. And then I completely forgot it last week, even though I was talking with Russ from Dapper Dividends on the Monday about it. And by the Wednesday, I was just so caught up at work and other stuff, I completely forgot about it. But it popped up again this week. They shot up. I think they opened up at $64 per share. And I'm like, it's a little bit much, but I still think I will buy them in my son's account, just because, I mean, Roblox for my kids, it's like Facebook. So anyone under 16 like has Roblox accounts. I have all my nephews and nieces. I think there's like 8 of them in total, and they all sit there on their tablets, honestly, playing Roblox with each other. It's just crazy. And they are playing with all their friends in school. So the reach that they have is sensational. Go on.
And how do they monetize on the kids?
So they have these things called Roblox. I don't know if so kids can buy these Roblox and use that then in games to purchase other games or things within the games and stuff like that. It's like similar to a Fortnite kind of monetization. So they have V-Bucks. So it's the same kind of thing. You buy this virtual currency and you use that currency then to buy stuff within the game. It's a really, really good actually business model and really addictive for kids. I mean, my kids, when their birthdays, they'll ask, can I get €20 Robux, or can I get €50? Like really addictive, and then they spend it on absolute rubbish in a game. But it's what keeps them handy. And what I do actually like about these is that they are they're free cash flow positive for the last couple of years, and I think it grew substantially from. Don't quote me on the figures; I don't have them right in front of me, but I think they grew from like 6 million in 2019 to 240-ish million in 2020, which is a big increase. So I find them a really good company, a little bit overvalued, but certainly an interesting model that Fortnite and other companies have shown that works. So my son will be happy. He's going to pick up a couple of shares of them anyway, and we'll see how they go.
These are always interesting companies for like the kind of 10% part of my portfolio, which are more focused on growth companies and non-dividend paying stocks. So I will definitely check them out and then see if I can make some soup from it.
we see. Don't blame me if it goes down the way.
Yeah, no, that's okay. I'm an adult. Then another news item that caught my attention was also brought up by Dividend Dane is that really interesting that Starbux, the CEO and the board suggested that I think it's Kevin Johnson that he would get a cash payment of 50 million if he stays with the company until the end of 2022. And I think his proposal for his base salary was 1.8 million. So, and 50 million is a really, really big reward, right? And I read, when I read through the details, the board thinks that the CEO would deserve that because he has created a lot of shareholder wealth. But when we did our episode about reading balance sheets, right, we saw clearly that Starbucks is buying so much stock back that it even got a negative equity, right? So, which means is that the other part of the balance sheet, the debt is carrying the weight on the assets. Yeah. So, and this is what I find interesting because they are so much financially engineering, and then the CEO is, because of the financially engineering, he's also claiming 50 million in cash rewards in a few years from now. So, and the institutional investors that I think together make up 86%, they rejected the proposal. So what I understood is that the board can still approve it, and that happens sometimes with some companies, but that would be really bad sign, I believe, if the board would now approve their own proposal and ignore the other shareholders' rejection.
I mean, as a shareholder, how could you trust a company that ignores 86%? You can't trust them.
Yeah.
I'm trying to scan through this article. You have a link. Is that 50 million based on any sort of performance, or is it just a stick around?
I don't know the exact details behind that. I mainly understood that it was more a retention bonus to keep the CEO around.
Because I think they lost their COO recently, haven't they, to Walgreens?
Yeah.
So maybe.
So in general, like, I find Starbucks a brilliant business, and I would love to have some of the company in my portfolio, but not at these prices, and specifically not knowing that they are doing so much financial engineering. And because that's how I look at the company. It's financially engineering. It financially engineered itself through the crisis. They have a great business, also a great digital experience, also with the pickups, right, that you can do. But the financial engineering keeps me off, and that's why I require a much lower price. And I'm thinking about Starbucks around $60. Yeah, when it is interesting. So it's probably half of the price about what it is now. So it just shows again, even while this Kevin Johnson is running a great business, but the financial part is important. It just shows like how rigged the system sometimes can be. That's how I look at that. So I'm glad that they rejected it. I believe it should be, compensation should be based on sustainable growth, in my opinion.
And performance. I mean, if you're just there and you do an absolute shite job, why should you get bonus?
But from a business wise, he is growing the business, right? But that's what I mean. Performance should also be sustainable. Yeah. How long can you keep buying back shares like they are doing? That's the issue that I have with it.
Yeah, well, he's growing, but there's a lot of engineering, as you said. So,
yeah,
is it really growing? if you get me, it is growing.
Yeah. He's taking let's say the future forward to today. Yeah, and that's what he's effectively doing. So someone will need to pay the bill in the future for this, and that's the shareholder.
Yeah. Cool. Look, it's not a company that I particularly, I don't say I like, but I don't like their coffee. So maybe I'm biased. I've said this before, and I just
But
stay
it's
away
not the
from
coffee; it's the cup with your personalized name on it, and being able to walk through it with the street. That's the brand power, not the coffee itself.
Hey, I used to write people's names on cups in my coffee shop a long time ago.
And look at what became from you. You're a wealthy guy.
So I have one more piece of news before we move on to our topic, which will discuss some interest rates. But it was with Nike. Nike is one of these companies that I love. I love Nike. I really like them. I like their brand. They've always seemed just too expensive for me to get in. But they had a disappointing year or quarter, according to their analysts. And I put disappointing, you can't see me, but in like in inverted commas. I mean, their earnings per share grew year on year and their revenue grew. They just did not meet the analyst expectations. So obviously their stock is now plummeted. They've had some issues. They've had some supply chain issues, and their stores are closed. Their stores are closed. I think 45% of them are closed in Europe, and 65% of them are now like running on reduced hours. So they have like lots and lots of problems. It's a difficult time for companies like Nike. I'm kind of hoping that they will drop in share price a lot as well. I think that I haven't valued under 100 to get into them a little bit, but I just find it interesting that how a company can grow their top line, miss expectations by a couple of percent, and all of a sudden they're just hammered in share price and it just shoots down. So it's one to watch. One to watch for me. I want them to come a little bit closer to my valuation, and then I'll dig a little bit deeper into the financials. But it's always one that's there that I'd like to get into, but just not at these prices.
I'm chasing Nike already since it got to $100, but that was pre-split.
Yeah.
Yeah, so several years ago, it pre-split, it was $100. I was considering already. I think it had a split 2-on-1, I think, or 3 or 4-on-1, and now it's again 100. So, and it's one of those companies I would love to have in my portfolio. I think I gave it even a tier 1 position or tier 2, but in the last 5-6 years, I still didn't purchase it.
Yeah, but the price. You look at their chart. The price has just gone skywards, hasn't it? I think they're a little bit overvalued, but it'd be nice if this was a little catalyst for them to drop down under 100, and then I might purchase one or two at that price, and then do a little bit of a deep dive into them, see if they're worth any more.
Nice, thanks. I will also have another look at it. Good point.
Okay, so we'll move on to our main topic, which is: should dividend investors be worried about rising interest rates? And we've seen this pop up a lot on Twitter lately and all over, and we put out this suggestion for tonight, and again it popped up in one of the groups we're in. So we might talk a little bit about that. I suppose the first thing that I want to clarify is the difference between interest rates and inflation, because a lot of people can kind of muddy the waters and confuse them up. So like interest rates, that's the percentage that you are charged on the total amount that you borrow, or what you earn on what you save. Whereas inflation is the opposite of that. So it's the rate at which you pay for your price of goods and services. So you know, maybe 10 years ago you could go to a shop and you could buy, if you had €10 in your pocket, you could buy X amount of sweets for your kids, and then 10 years later you go to the same shop and you can't buy as much. And that's basically what inflation is.
Yeah, and it's really interesting now, right? Because inflation is still low. Yeah.
Mm-hmm.
However, interest rates, and when people are referring to that, they're referring to the 10-year Treasury note from the US, has been picking up quite rapidly, because last year, so maybe good to know, I believe it is now around 1.7%, the interest rate for those 10-year Treasury bonds. It was like that also just before COVID-19 broke out last year. It was on a similar level, but then it dropped to really low, I believe 0.5% or something like that. But lately, in the last 2 months, it really grew quickly, almost about 1% again. So people get scared of this now. And then the question is like, why are people getting scared of it? And if you read the financial news, it's really hard to grasp because they use a lot of financial terms, and I will probably use some soon as well, but I try to do it in simple English. And at the same time, you only see the headlines from the pundits, and everyone says like, yeah, interest rates are going up, so we need to turn into value stocks. But for them it's all a no-brainer, but for us as let's say novel investors, like, okay, so what do they really mean, at least for the ones that think about it, right? Because most of us might just parrot it and think like, oh, it means something bad, so we need to watch out.
Yeah.
So and then
it's it's good you say that, because I was scanning through the usual Bloomberg and Yahoo Finance, and they have Nasdaq is rallying after the yield has cooled, and it's all based on this narrative. So it's, I mean, if you're an investor and you don't look into it, or I mean, maybe you're a little bit green like me on it, you see these topics and you automatically assume, wow, this is bad news, where it's not always the case. But I suppose the question is, why do these matter to stocks, and why would the stocks go down as a result of this?
So for that, you need to understand like some basics about, let's say, valuating companies first. So followers to our blogs, they know that we use often the discounted cash flow valuation metric, right? And why does that matter then? So if discounted cash flow is based on the upcoming cash flows, let's say in the next 10 years. Yep, and a part of that, to calculate that and discount it today, you need to know what the cost of capital is. Let's say that the cost of capital is 10%. So for the €1 next year is worth today 90 cents. Yeah, and like that.
Yep.
But imagine now that the cost of capital increases to 20%. This is fiction, right? Just an example.
Yep.
It will be only worth 80 cents. So if you then multiply, let's say 80 by 10, it becomes like €8 instead of €9. So you want to pay then only €8 instead of €9, right? So your stock prices go then down as a result. Now there are two components to calculating the cost of capital. That's the cost of debt. So everything you own to the bank or to the bondholders, but also the cost of equity. And the cost of equity is a bit harder to calculate because it's based on shareholders, what the shareholders expect. And the expectation is driven by certain factors. And a way to calculate it is, and this really, we're going to really into the accounting, is called the capital asset pricing model. And in there's one component that is called the risk-free rate. Yeah, so to calculate the cost of equity, you need, for instance, the risk-free rate and, for instance, the expectation that investors give to the required return, for instance, from such a stock, and, for instance, the beta of a company. I think those three components. But let's take now the risk-free rate. What is considered the risk-free rate? That's a 10-year bond yield from the US government, because that's considered the safest place to put your investment, your money in.
Yep.
So if you then understand that this component in the cost of equity is rising, you can then all fold it back up again all the way to the cost of capital, that it will increase. And it might not increase with the same percent as just it grew in the last 2-3 months, but maybe with 0.5% or something like that. And that 0.5% already reduces the amount of value of your future cash flows that the business can generate. Hence, why it can have a negative impact on stock prices. And this is specifically the case for high-growing companies a lot, I would say. So, and this is really why people are afraid of rising interest rates. So, and then the question is, why is the interest rate rising? Because the Fed is still printing money, is still having zero interest rate, but they're focused, the Federal Reserve, on short-term interest rates, like overnight interest rates, to allow the system to have a lot of cash in the system. But what is happening, the market is thinking like, oh, wait a second, but inflation is coming because, I said, there's a lot of money coming into the system with new stimulus checks. So people will have more purchasing power. They will start buying more. That this will increase also inflation, because prices will become more expensive as a result as well. Hence, it's nice that the Fed is doing this, but the market believes that there will be growing inflation, and hence what is usually a result of growing inflation is rising interest rates to cool down the inflation again. Yeah, because if the inflation gets too hot, you want to increase the interest rates so that inflation goes down a bit again. And that's really the game that the Federal Reserve is playing.
Yeah.
So,
and you spoke a lot about the future cash flows and it's affecting the price of a company. So you expect the price to go down. But I'm a dividend investor. Why would that matter to me?
So there are two components here, because you're not just a dividend investor, you're also a value investor. Yeah, because you just mentioned that you don't want to buy Nike at these prices. So
True.
that means you put already a valuation on top of it. It also means that you work with a margin of safety. So usually, this is why you see and hear also that there is a rotation of growth stocks going into value stocks. Because when you're a value investor, then usually the impact is a little bit mitigated on this with higher interest rates, because you're looking more for value already by definition. So our stocks can go down, our portfolio value can go down, but we're in it for the dividend income. So it shouldn't really matter if you're not aiming to sell your stocks. I rather see it as an opportunity if prices go down, because it would allow me to buy more dividends for the same dollar or for the same euro.
And would you eliminate maybe low yield stocks as a result of this?
They're anyway already eliminated from my buying decisions, because I have a minimum yield requirement of 2.75%. So for me, low yields are generally not interesting for me, because if they have a low yield and a payout ratio of 50%, that means really that you pay a high multiple for the earnings, because it means that the earnings yield is also quite low. Yeah, so for me, those are not so really attractive. Sometimes I could recommend, and I even did it once, to buy a high yield and a low yield together. If you want to get into Microsoft as an example, then that might be interesting. But generally, I don't have low yield stocks, and because every stock that goes up, they always go through summer and a winter, and there will always be a chance. Also for Nike, I'm sure that I will buy some Nike in the upcoming 4 or 5 years at an attractive valuation for me.
Okay.
How do you look at it?
So, with I've been challenged on this actually this week. There's a guy called Charles. He runs a website called Financial Freedom as a Journey. He's from Canada, and I wrote an article about Stryker. You might have seen I posted, and the reason I chose that, so he gave me a list of companies that might be interesting, and Stryker was one that kind of stood out, because it's one that never passes my screeners, because I typically look for 1.5 times the dividend yield of the S&P 500, the average dividend yield. So they have 1% dividend yield. So, and never in a million years would have even looked at them before. So I took that opportunity to learn something new and dig into them. And I was quite surprised by the numbers. Their annualized return over the last 10 years is 17% or something like that, something crazy. Cash flow is strong, and the dividend growth, I mean, over the last 10 years, it's nearly 15%. So I was wondering, am I missing a trick by having it so strict and eliminating these companies? Because I mean, I know it might take maybe 20 years for it to get to a yield of cost on of 10%. But that's when I'll be hitting my retirement age, which is when I wanted to do that. So
yeah.
I'm not in an immediate rush right now to buy a higher yield. Like, so I'm more open to lower yields, starting with a higher dividend growth. But then it needs
to be a really special stock, and you should be counting on the fact that it has still a decade of similar growth ahead
Yeah.
of it.
Yeah.
Because we usually look backwards in this, and then it's easy to say like, oh, I would have, right?
Yeah. Yeah.
But
I mean,
do you think it will grow still 17% annualized over the next decade?
I think so. I think the market that they're in, I mean, in the medical devices, they deal with like hip replacements, knee replacements, and
Yeah.
it's a growing industry. I know personally, I've had family members that have had to get that done. I know you play football. A lot of people that play repetitive sports such as football, where they're kicking with one leg constantly, will need to get this done when they're older, and that's just a fact. So I can see them growing. They're making some excellent acquisitions. I don't know about 20 years time, but I'm certainly confident in 10 years time they can grow at that pace.
But in that case, it might be interesting, right? Exceptions. So rules are there, but I always feel that exceptions are possible as long as it doesn't become the new rule.
Exactly. Yeah, that's true. But how do you find these exceptions if you're so rigid to your rules?
Well, as a blogger, it's really easy.
Yeah, that's true.
People often come to you in the DMs proposing companies to look into them, and I never close myself for this. I always at least check them out a little bit, and yeah, sometimes I'm positively surprised. So,
And how about inflation then? Where does this fit
yeah,
into
inflation is
this?
actually more. I'm more worried about inflation from that point of view than interest rates, because when you think about inflation, and maybe this is also where we can bring a question from Dividend Dane forward, because he's asking us like, what do we do if inflation happens? Because what if inflation goes for extended period of time above 2%? And let's say 2.5 to 3% for an extended period of time. So that will have an impact here, because look, first of all, I will still be growing my income because my expected dividend growth that I'm looking for in companies is around 6% per year annualized. Yeah. But let's say that I think my performance so far was a bit underperforming. I think I was around something about 5%. So still, if I would be retired with an inflation of 3% and my dividend income would grow with 5%, I will be able to cover the inflation. Yeah, it is actually an more impactful on the accumulation phase. And I actually run it through my calculator. And if by definition I calculate with 2% because it aligns with the long-term thinking of the central banks.
Yep.
But when I changed it to 3%, my retirement date was brought back with at least a year to almost 1.5 years. And that's the impact of a higher inflation, because I will need more money at retirement than I would have now to for instance cope with the costs, because I also need to put more money into the investing then.
Yeah.
So and that's the fact. So inflation on such a level is maybe not so good. But again, if inflation is higher, usually the input of costs are higher to a company, hence they might earn less income. If the dividend safety is there, we should be fine. But this is where the issue comes with all these leveraged balance sheets. So it's probably wise for us as dividend investors to prepare and do all the debt analysis of our companies. But if that's the case, you get to buy probably the companies at a better price again. So then you get again a better yield. So it's all about the entry level that you step into this company. And there it's again that we have a benefit of the I said of being in an accumulation phase. So if you then look at all these impacting factors, I tell you, I have no effing clue what will happen to it. What I only know is I need to stay the course with this and take it at a month at the time and see how my portfolio responds. Because I don't think many of us have experienced high inflation, because I started in investing 6 years ago. So I've not lived in a world where there was pre-financial crisis where you could get 4% on a savings account. So this will be new to me. I really need to take it 1 month at a time or a half year at a time, and in such cases, I will reevaluate.
Yeah, and could you see investors become more focused maybe on higher dividend stocks?
Higher dividend yields. Yeah, I think so. But the question is, will your portfolio go lower and therefore give you a higher yield in those companies to invest again? Or does it mean we all go into AT&T now? Yeah.
I'm not quite sure about AT&T, but
Yeah.
I'll put a link. I'll put a link in this description. But I've sent you this report just before we went on air. But there was a report by Global X Management Company on the effects of dividend companies in a rising interest rate, and it was one thing that kind of stuck out to me, that they said, like, with an average yield of 6.4%, high dividend stocks outperformed the market in, I think, 8 out of the 10 times that this is sorry, 7 out of 10 times, by an averaged annualized percentage of 0.8%. In 3 periods where the dividend stocks underperformed, the interest rates increased unusually rapidly, so really fast. But if it's rising steadily, which it seems to be, high dividend stocks tend to outperform the market. So that's a really interesting study, and I'll put a link in the description for anyone that wants to look into it a little bit more.
Yeah. So I guess to sum it up from my side, rising interest rates lead to higher cost of capital, which means a lower valuation on the future cash flows, effectively. And I think that's why people are worried, and the interest rates are increasing because people think inflation is coming up, and when inflation is coming up, then interest rates tend to rise as a result. So it's kind of demand supply. What I didn't mention actually is that the 1.9 trillion stimulus going into the American economy means also that there's more supply of 10-year bonds. So that means that the people buying it can effectively demand more in return. Yeah, if demand is weaker, they can just demand more interest in return. That's also seen as one of the reasons why the interests started rising. So, yeah, I hope that this helps. I mean, I'm not a financial expert as such. It's what I know from having read some of the books in the past. And I'm eagerly to hear also from other specialists once we post this episode on social media what they have to say this as well. I think this is really a topic for the community, but I'm glad that we have this topic, because it's good to go a little bit below the headlines, and what we see from the pundits on TV, because it doesn't say us anything.
Yeah, I mean, I'm not too worried. I mean, you look at historical rates. You look at 1986. I'm just picking a random year, and it was 8%. Warren Buffett was a dividend investor in 1986. So I mean, there was money to be made. He didn't certainly go broke or panic because of it. So I mean, it's going to be new to me, just like you, a little bit newer to me. So I'll just do the same. Take it step by step and learn from it and see how we go.
But EMF, we had 1.7% interest rate last year, January, February. So it's not now suddenly that the world is upside down. I think it's the pace of which it grew over the last 2 months that got people scared.
Yeah, quite rapidly, but you can see it's starting to cool off. But hey, look, time will tell.
Yeah, cool. So now that we have discussed this main topic, let's go to our usual section, the listeners' questions. And I believe we got several in again. And maybe I'll start this one with you. And of course, it's Phil who's the first. And he brought some rapid fire questions to us today. So I'm going to ask you a few questions, and the idea is that you quickly answer them, and then you can reflect a little bit on why you chose what. The first one is Pharma or BioTech?
BioTech.
And then Europe or North America. However, it might also be the rest of the world in general.
I'm going to say Europe.
Okay. Cathie Wood or Warren Buffett?
Warren Buffett.
Cool. Would you like to clarify one of the answers?
So the Europe or North America, I'm not sure, is that where I want to live, or I wasn't sure the context around that. So
it was, I believe, in when it comes to dividend stocks.
Oh, dividend stocks. Okay. Oh, it probably would have been North America with dividend stocks, I'd imagine. But European stocks are creeping up. They're now 40% of my portfolio, which is nice, which is what I was aiming for. I was aiming for that 60-40 split, so I've got that.
Yeah. Okay.
How about you, Cathie Wood or Warren Buffett?
Warren Buffett.
Yeah.
I really like Cathie Wood, but what I like most is her research. But I think she is in a shitty position now, because she has so much cash flowing in, and she's buying all these small companies or investing in all these small companies. So I saw several times already where people were saying like, "Here's where Cathie started buying. Look, the price went up so much because there comes so much capital into those small cap stocks."
Yeah.
That she's becoming too big. And this is always what Buffett says: when you become so big, where if you want to not be having such a big impact on the market, you need to invest rather in the apples of this world. And I think she's experiencing this problem now as well. And the question then becomes like, what is really the value underneath it? And because if the market goes against her, and she starts selling those companies, I mean, you get just pump and dump with those companies, and you can't blame her. It's just her popularity.
Yeah, it's not her fault.
Yeah, so I rather go with Warren Buffett, the time-tested approach. Yeah, usually what I like the story of Chamath. What he said one time is like, you want to be in businesses that do slow compounding rather than fast compounding, because fast compounding means like there are probably no market barriers to enter, so you can also quickly get disrupted again.
Yeah.
And nobody knew Cathie Wood around this time last year almost, and now she's one of the investor wizards. So I wouldn't be surprised if at a certain moment she falls down also just as hard. Yeah, I think her name is there to stay, but let's see how it goes in the next crisis. Because remember, Cathie Wood didn't go anywhere, I think, in the 9 years or 8 years up till this moment. Yeah, and I agree with all her theories that I said that there's a momentum now in the investing themes, because this research is really excellent that she has done. But if we get now a market crash, and we've seen already a little bit like a few weeks ago what happened to her funds, imagine that we get a 30% drop and the sellout that we can see there. Ooh, I think it will be of epic nature.
Yeah, it'll be a testing time if that happens.
And Buffett will be just buying his shares back.
Who said it? Abbey V recently, he's getting like, was it 3 million in dividends or something from just one company alone? It's crazy. It's crazy. Peter actually followed up on that question about Europe and North America, and he wanted to include other emerging markets such as Russia, especially because they have like a low PECA CAPE on their cyclical markets such as materials and energy. So he's building up a position here. But how do you feel about Russia or emerging markets like that?
So I think it's wise to do that, because you're diversifying your portfolio. And I said, if you find interesting picks there, you should just do it. I'm not doing it myself for a simple reason, is that I can't start looking at those markets as well. I just don't have the time for it. Yeah, because if I go into Russia, I want to not only understand those 2-3 companies in Russia, but also need to understand a little bit the macroeconomic dynamics there. I just don't have the bandwidth and the mental power to look into that and start following that as well. But generally, I agree with theory. I mean, there's probably quite some potential there in the eastern side of Europe.
Yeah, I mean, you have to remember these guys are coming out of communism, and it's not easy. And as you said, you have to kind of understand the dynamics of that and what that means for us as investors. I would much rather invest in an ETF, an emerging market ETF that covers a wide range, that will have the top 2 or 3 companies, and then I don't have to worry about that stuff. Just pick an ETF for me.
That makes sense.
That's what I would do.
Okay. So then the next question is from Rafa. And he asked about, and we might have touched upon this already, but could you name a stock that you would love in your portfolio, but you never bought because it always seems so expensive?
Yeah, I mentioned Nike already, but Visa is another one. Visa always seems too expensive. McDonald's always seems expensive to me as well. So a couple of companies like that.
So for me, it's also Nike, and maybe a funny story. I owned McDonald's. I remember buying it at $90 several years ago, and I sold it at 120 because I thought it was way overvalued, and I sold it then at 120. And of course, we know where the stock is now. That's also one of the reasons why I don't sell my winners anymore. I learned that it makes really no sense, and sometimes companies just grow into their earnings or the earnings growth into the price that is paid in the market. But you need to know at that time, McDonald's was hated everywhere. There was a period like 4 years ago that even in my surroundings, nobody wanted to go to McDonald's and such. But suddenly, I think it was just for half a year, and that's also when I sold it. And suddenly, everyone went back to McDonald's again. So it is like McDonald's is just an addiction. There can be maybe a trend that for you read something in the news, it gets some bad press, and people think like, oh, you shouldn't eat this stuff anymore. In the end, McDonald's always wins. Yeah. So that's what I learned.
It's a similar story to Apple, isn't it? Apple were almost hated going out of business, and then they went and look well. I'm a little bit disappointed in you though, because we get that question quite a bit. If a company reaches X, would you sell? And we always say no, hold on. Disappointed that you did that.
Yeah, but this was before. This was several years before, and then I was still. I had this fear. This is becoming too expensive, and I was thinking, if I then take my profits, I can use it to invest it in a higher yielding stock, and then I wait until those stocks pop up. But then I was in mind more value investor, I think, than I said a dividend investor.
Yeah, and I think it's a natural reaction. I think we've all had those thoughts at one stage. I can't remember who said it, but they say the best investors are the ones who are dead. Do you know what I mean? They don't touch their accounts, and they're the kind of lessons that you learn. But it's hard when you're faced in that moment, when you have a company like McDonald's that are so hated at a particular time. It might have made sense to get out of them.
Yeah, and I did, of course, all my analysis, and I felt like no way they can ever do this. And then they come with the new menus, double down on coffee, and earnings started to rise. But still, I think they're way higher than where they belong. But I did sell a quality business, and that's what I regret.
Yeah,
not that I sold in such, but it's a quality business.
They're more than just a restaurant, aren't they? They're essentially a real estate investment trust. Like they're essentially real estate business. But hey, you live and learn.
Yeah.
And then we have a question from Diego Diaz. I read he has a Substack. I think it's only new. I read that today, and it was quite good. I'd recommend checking it out for anyone that's listening. But he asked us a question: how do you keep track of hidden FX fees when you buy non-euro dominated stocks with DAGEO? And if so, how do you calculate and register them?
So I don't track that. For me, look, DAGEO has low costs, and it's probably earning the money on the currency spread. And this is no other than credit card companies and such. They take 3% on every transaction I made. So for me, it's kind of part of the system. I hate it because the transparency is not there. But for instance, in DAGEO, I pay 50 cents or something like that for a transaction on a US dollar stock, and for €5 on a European stock. Yeah, and on my other broker that I still have, I pay like minimum €8 fee. So I'm not so concerned with this here. I hate this lack of transparency, really. But I also learned in the past that sometimes I spend too much time on these kinds of topics, and I become kind of penny wise and pound foolish. So it's part of the system. If you think about trading 212 and all those, there's always a hidden cost. And if it's either hidden because they earn money from the international transaction, from the spreads, or even just they put the risk on you. Yeah, and that also has a price when shit hits the fan. So
yeah, I mean, you hit the nail on the head. They're a low cost broker. They're a low cost for a reason. They have to make money somehow. I mean, it's a business at the end of the day, and we don't want them to go out of business because then we're up shit creek. So I'm not too concerned. The spread, I don't even know what the spread is or how much they're making. I don't know how hidden it is. I'm sure it's in their terms and conditions somewhere, but I don't look at it. I never even noticed it until I've read this comment today.
Then the next question is from Daniel, and he asks, how would you currently invest a lump sum of 30,000 euro? How many dividend stocks would you choose, and how much would you invest in each?
Just put it all into Bitcoin and retire. No, 30,000. I'd probably buy. I would focus at this moment in time. It's hard. It's really hard to know what I would do. I'd probably put it in my top 2 or 3 companies, maybe 10,000 in each. Johnson Johnson, Microsoft, and maybe ABV.
So with such an amount of money, there are 2 different approaches I would take. If, for instance, a family member with not too much understanding of investment would ask this, I would say put 20,000 in an ETF, dividend ETF or something like that, if they want to earn a return, and the other 10,000 do it in few high quality stocks, and then I will probably recommend them as family members. If it would be for me, if I would get now 30,000, I would probably spread it over 10 companies, because I know what my tier 1 till tier 4 companies are, and I will probably spread it over 10 companies, 3,000 each there.
Cool. Okay, and then the last question of the day goes to Dividend Chef. And when he asks, his question is, when he does his valuation, he has a margin of safety, but sometimes when the stock price hits his value without his safety net, he just can't control his emotions and he just buys the company anyway. How do we handle this if we do this?
Well, exactly the same. Sometimes I think like, fuck it, I just buy it. I'm too impatient. Yeah.
I mean, the margin of safety is there really because you have to make certain assumptions. Assuming you're doing a discounted cash flow or dividend discount model, you have to make certain assumptions of, I mean, the discount rates, the weighted average cost of capital. You have to make these assumptions, and you put a margin of safety in there on the assumption that you're not an expert, you're not doing these detailed, minute macro calculations, so you have a safety net in there. But what I tend to do there is I look at the PE ratio. So I look at the historical PE ratio of like 10 years. I look at the estimated, so you have analysts that estimate your earnings per share over the next year. So I get the median of that, multiply the 2 together, and if it's within range, I'm more than happy to buy.
Yeah, but don't do it for Nike, because those analysts are quite wrong, as we learned earlier in the show. So what I do this usually when I want to initiate the position. Then I'm when you're analyzing a company, you feel like, oh, I want this one in my portfolio. Then I would do probably the same as Dividend Chef. I would just probably buy it, let's say, for the first 5% of my portfolio, just at the fair value price. But I do get more greedy as the position grows. Yeah, and then also this newness is of it, so it's easier to keep my emotions also in control because I own already some of the shares.
Yeah, it's a good question, and I think everyone that does any bit of valuation will have that. You'll see it drop down, and you'll want to buy it. And one company that I've done it with was Microsoft, and I had them valued at 180. They were just never going to get there, so I just dipped my toes in, and I look at 200's a fair value from, so I got in around that price.
Yeah. Super. So that was the last question for today. And with that, we are coming to the end of the show again, EMF.
Wow, that was quite quickly, actually. It was interesting topic for me today because it's something that I've never really given too much conscious thought to. And I know it's a hot topic on Twitter and that. So I hope people have learned something from it. If they have any questions, feel free to reach out. We've got some great comments and emails recently, so keep them coming. We answer everyone as much as we can, and it's great to get all these questions from the community.
Yeah, and maybe to repeat, for people that are not on social media, you can reach us at dividendtalk@gmail.com. So that's how you can send your email to us, and we'll for sure take it up in the show.
Cool. So I think that's a wrap for today. So thanks again to everyone for listening. Thank you for your insights today. It's helpful as always, and we will see you all next week.